What's up, tycoons? It's Bafi bringing you end of the month stock portfolio recap. I was so close to getting my wish that I've been praying for nearly a year. So stick around. You're going to find out exactly what that wish was about. Cheers. As always, we're kicking it off with our dividend payouts. February is one of those months where dividends tend to be on the lower side because obviously most companies pay dividends quarterly, meaning every 3 months, depending on whatever order or whatever cycle that the companies that you've invested in pay out their dividends. With that being said, for the month of February, we received $90 in total dividends, and we always reinvest our dividends. We never touch it. The point of investing is so your money can make you more money, and that the money that money makes you makes more money. This is an increase of 43% compared to the dividends that we got paid last year in February. So we're definitely heading in the right direction. And that's why you want to keep that long-term vision. Time to talk about what I've been wishing and praying for about 10 consecutive months. And unfortunately, it was snatched away from me last minute on Friday as the market winds down to a close. And that was, I've been waiting for my first down month in the last 11 months. And we were really close this February because, interest rates, a lot of news, a lot of volatility, which is what I love the most. And sadly, we finished in the green. So that makes 11 consecutive months of finishing in the green. Fingers crossed, maybe next month we'll get a lot of red days and we'll see what happens. Well, Bafi, everybody wants their stock portfolio to go up, right? After all, that's the point of investing. So why do you get more excited about your portfolio going down? Man, that's because the mark of a tycoon investor is made in the bear markets, not in the bull market. For the last 8 to 10 months, everybody have been riding this bull market, this high that everybody's on. And that has led many retail investors to make poor financial decisions, specifically investing in riskier assets without really understanding what's happening. As equity markets take off into the sky, aka stocks only go up, people are willing to bet on riskier assets because their ego is at the roof, their emotions is at the roof. They think they're invisible and untouchable. But that is when life always have a trick up its sleeve. The moment you think you know more than life itself, that's when it has another lesson for you. There's been way too much speculation going on all levels. Everybody have a platform. Everybody think they're a stock market guru now. So these corrections are much needed because a lot of times people need reality checks, okay? Some people don't get it or won't learn how to properly invest until they get smacked in the face. You can choose to invest in the stock market the easiest, simple way, or you can choose the hard way. Unfortunately, most people want to take the hard way. Why? It's beyond me. A lot of people think just because you're buying stocks makes you an investor. But are you really an investor if you don't know what the premise of buying a stock really means? Are you really an investor if you don't know some of the basic fundamentals of the economic system and their functions, right? Knowing a fraction of that can take your investment skills and knowledge and all the headache and the guesswork out of the game, and it can take you from A to B. Understanding a thing or two about GDP, the Federal Reserve, the central banks, our bank system in general, aggregate demand, supply and demand curve equilibriums, all these other functions. It gets technical, but I don't want to dive into all of that. But understanding some of the basic foundation as to what levers and what forces is at play during bull markets, bear markets, volatile times, contractions, understanding just a little bit of that saves you a lot of headache. Believe me. All right, enough with that. Let's dive into the market conditions. Retail numbers came in pretty strong. People are spending more than ever, of course. You give a 19-year-old a stimmy 1,400, guess what? They're probably thinking PS5 and the next iPhone. So a lot of spending has been going on. Jobless claim, however, did go up. Expectation was around 700,000, but it came in around 861,000. A little bit of uncertainty surrounding monetary policy of this 1.9 Sleepy Joe stimulus that is to come out. They haven't finalized everything yet, but I think they're inching closer and closer by the day. Unfortunately, he's not forgiving student loans as he previously had somewhat mentioned, but that's not going to happen. So everybody with student loans out there, please get out of debt. Save yourself. Sleepy Joe not coming. The last 2 weeks have been exciting with a lot of volatility and some corrections, which I'm happy about because most people think stocks only go up, but this is about time stocks came back down to earth, to reality. Fear of long-term interest rates kicking up, starting with the 10-year treasury bonds. Rising above is 1.4% mark. So as you can see, some people are going to move some liquid into bonds. And let's not forget, there's a lot of old people that are in retirement mode or close to retirement. Therefore, they must allocate their funds different. So they don't need to be heavy in equity/stocks. They need to have more bonds to protect their nest egg. Shout out to bonds. James Bond. That was terrible. An interesting fact to know is that household debt is now at $14.6 trillion. That is the highest it's been since 2008, before the housing bubble. So is this something we should be concerned about, or is this good for equity markets, the economy, and the housing market? Yeah, February is a short month, so we're going to keep it short, nice and brief, straight to the point. I'm excited, looking forward to March. Let's see what the future brings, and I hope Sleepy Joe sends us some stimmy, because I'm ready to reinvest that money back into some stocks and get the next dividend rolling. So I hope everybody had a wonderful month. If you're down this month, you're not doing bad. If you're down like 5, 10, 15, 20%, you're probably doing bad, because the S&P is probably up maybe 0.3% for the month. So if you're doing that bad, that means if we get a 10% correction on the S&P or 5% correction on the S&P, your portfolio is going to take a pretty heavy hit. It means your foundation on how you started your portfolio, you probably need to revisit your strategy and your foundation. A lot of people are freaking out, but when you really look at it, we only have a very tiny baby correction. This is nothing. This is a blip. I'm hoping for a 10, 15% correction. Everybody's been riding the high again. Like I said, everybody seems smart, seems to know what they're doing, but sooner or later, things have to come back down to reality. And when the tide goes out, that's when we find out who's been swimming naked. So last March, I was excited and to see how our portfolio performed, and it's been going up and doing phenomenal since then, even though I'm praying that we go back down. But you're not a tycoon investor in a bull market. Everybody is doing well in the bull market. So every strategy is basically kind of working right now. The mark of a real investor is when we hit a bear or a recession market. That's when your real investment strategy is put to the test and your emotional intelligence is put to the test. So everybody keep the long-term vision strong. That's why we advocate investing for at least 10 years and beyond. Always have some reserve cash that you can take advantage of opportunities when they arise. And keep the long-term vision strong. Get rich quick is dead and never lived. Anybody that promised you insane amount of gains in a short time have no idea what they're talking about. More money invested, longer the money works. The more money you keep, the less taxes you pay. So that's why we love long-term investing. Have a beautiful weekend. Enjoy the rest of your day. We'll see you guys end of March 2021. See.